Now we will take chapter 6. Chapter 6 is part 2 of the investment. We talked in chapter 5 about short-term investment, which is capital markets. Here in this chapter, we will talk about capital market, which is long-term investments. What we mean by long-term investment, that the investment that has a maturities over than 1 year. So now let us refresh our knowledge. Overview of the capital markets, mainly divided into two main markets: money market, which you take in chapter 5, maturities less than 1 year; capital market, maturities exceeding 1 year. In the capital market, we have two sections: debt market and equity market. If you are investing in the capital market, you may be either one of two. Either you are one of the creditors to the company, or you are one of the owners to the company. So if you are one of the creditors, you are investing in the debt market, which we called fixed income securities or fixed income capital, like bond and long-term loans. Equity market means that you are one of the owners, which means that you have some specific ownership of the company with stocks either common or preferred. The debt instrument is a lending agreement between two parties: the issuer, who is the borrower or the seller, who borrows the money from investor, the investor who is the lender, who is the investor, who is the buyer. These agreements commonly referred as a fixed income securities. Why we call it fixed income securities? Because your money is guaranteed. You guarantee how much you will be paid. You guarantee the timing of the payment. You will receive your money at June 2023. You guarantee which currency you will be paid in. You will be paid in US dollar. You will be in Saudi Riyal, in Egyptian pound, whatever. But this agreement commonly referred as a fixed income securities because the periodic payment of interest considered as income for the investors, and the rate is fixed. Not the rates only, the rates, the time of the payment, the currency of the payment, the way of the payment, everything is guaranteed. The maturity range from 1 year to 30 years. Liquidity of the debt instrument inversely related to the maturity. What does this mean? This means simply, if you have investment with a long maturity, no one will be willing to buy it. And if you have a bond with a maturity in 30 years, if you want to sell it in the market now, not many people want to buy it. But if you have a bond with a maturity within 2 years, a lot of people want to buy it. So as long as the maturity is higher, the liquidity is low. The maturity is low, the liquidity is higher.
Okay.
On the other side, the equity instruments. Equity means you are one of the owners of the company. Equity means that the investor is now one of the owners of the organization based on his percentage. As long as of your ownership, it gives you some privilege. The ownership result in earning dividends and the capital gains. What is earning dividends? The dividends that the company distributes some of its income to its owners. And capital gains. Capital gains mean what? Simply, if you buy this stock for $1 and after 2 years you sold for $3 or $4, the difference between what you sold and the original purchase price of the stock, we call it capital gains. And in some countries, these capital gains are taxable. The equity investment does not guarantee a fixed income. Here is a very big difference between debt and equity. The debt, we call it a fixed income security because you guarantee how much you will be paid, when you will be paid, in which currency you will be paid. On the other side, the equity does not guarantee anything. There is nothing guarantee. You do not guarantee if you will pay it or not from the beginning. There is no guarantee of the payment, and if there is a payment, there is no guarantee how much you will be paid.
There is one question. One question here.
Yes, please.
As you said, in equity investments don't guarantee fixed income.
Do not guarantee income from the beginning, either fixed or variable.
Okay, but you remember when we discussed chapter number 19, so we said there is a difference of common and preferred stock, where you give me the difference that preferred stock guarantee.
Now we are talking about common stock because the preferred stock as an exception. The preferred stock is something, an exception, and from my point of view, or from this is outside the book. The preferred stock in many countries, the preferred stock is not allowed by the law. For example, here in Egypt, by the Egyptian law of investment, we do not have a preferred stocks. Okay. So the basic idea of equity is common stock. The preferred stock as an exception. I think also in Saudi there is no preferred stocks. It's only allowed in UAE, in the Middle East till now. So
Yes.
when we are talking about equity, mainly we are talking for the common stock because the preferred stock is an exceptional items.
Okay. Okay.
Okay.
That's why I had a confusion that
Oh,
when
no,
you
no,
are
no issue.
telling the equity investment, don't guarantee. So I
No,
okay.
no,
Okay.
no,
Now
no,
clear.
no issue, my friend. I'm always here.
Okay. Okay.
Equity
Okay.
investment may become a zero value if the company went bankrupt. If the company went bankrupt, خلاص, you do not have anything to own. Everything is gone with the wind. But
Okay.
let us see who are the key participants in the capital market. We have a lot of people are playing in this market. Number one, the issuer of the securities. They are the supply side of the investment instrument, the capital. They are the organization or the people who are giving or supplying the investment tools in the market. They are borrowers. You remember in chapter 5, we
Yeah.
call them borrowers, sellers, or issuer or borrower or sellers. Issuer of debt securities are borrower. Issuer of equity securities are. Here is a big difference. If I am lending from you, that means I am borrowing from you. But if I am selling you equity, this means that now we are partners. So issuer of debt securities are borrowers. Issuer of equity securities are selling a part of the organization they own. The
Okay.
governmental and not-for-profit organizations, they do not have an equity, so they take only debt because there is no equity to sell. The company the government is not owned by anyone to sell the government or sell a share of the government. So governmental and not-for-profit organizations issue only debt securities. Why? Because they do not have equity.
Okay.
Okay, let us see the governmental debts, governmental and central bank, which is the debt securities. Many governmental and central bank issue debt securities with many maturities. These securities are supported by the credit worthiness of the issuing government. Yani now Egypt is selling governmental bonds in the European market. The guarantee is the credit worthiness of the Egyptian government. Why they are issuing these debts? They are using it to finance the deficit, the country deficit. Who is issuing? Either Ministry of the Finance or a central bank. Central bank in some countries issue their own securities to finance the acquisition of the assets. Now, the central bank his main role is the bank of the government. He is not a commercial bank. He is the bank of the government, so who is serving the government. But in some specific countries around the world, the bank is doing the business of a private bank. So he may be in some countries issue their own securities to finance the acquisition of assets. On the other side, in some countries, central banks are banned from issuing debt to finance the government. That means if the government went to the central bank and asking him to borrow on behalf of the government, he will refuse. By the constitution of this country, he will refuse because he will simply tell the government, if you do not have the mentality to manage your own resources and to provide the money for your own resources, you should leave and someone come, because this is a debt for the people of this country and the next generation who will pay this. So in some countries, the constitution approves this. If the central bank is banned and he cannot borrow for the government, but this is in very good countries, not like us. Right, now let us see corporations, debt and the equity securities. Corporation, including financial institution, raise the capital through issuance of stocks and bonds. يعني the corporations, the normal corporations, يعني they issue bonds and they issue stocks. Corporates are a major issuer of the long-term debt in a variety of forms and maturities. Most maturities range from 3 to 15 years. يعني this is the most one. Longer period issued bonds may be issued at the time of low interest rate. If you are in a situation where is that now the interest rate are low, you may take this privilege and issue long-term financing bonds, for example, for 30 years, and use and take the advantage of the low interest rate during the period of issuance. Why you are doing this? Because you guaranteed or secured a long-term financing with a very low interest. Corporates
Yeah.
are also a major issuer of the equity securities. and as they must be they may be other hybrid securities. We call it hybrid. It is a mix, like as a convertible bond, which combine both debt and equity feature in a single investment, like the preferred stock, as we talked.
Okay.
We have something also called state-owned enterprise. State-owned enterprise. State-owned enterprise is an organization created by the national government to participate in help in supporting commercial activities on behalf of the government. It may be 100% partially or partially owned by the government. The government may own 100% of this entity, or just a small partnership, like in every country there is one or two governmental banks. In Canada
Yeah.
and the UK, they are called crown corporations. In USA, they called governmental sponsored enterprises.
Okay.
What we have else, we have sub-sovereign entities. They are debt securities. Governmental units within the country, they are borrow heavily in the debt market in many but not all countries. As we told again, the government only issue debt securities. There is no equity in the government because the government is not owned by anyone. In USA, interest paid to investors on such investment is a tax-free from federal income taxation. In USA or United States of America is one of the countries where they have one of the highest interest rate all over the world. But on the other side, is you are paying taxes and you are receiving a lot of services. So the USA citizen or the USA investor, the tax consideration is very important to them because they have around 40% tax rate. So they are always searching for an investment that is tax-free. The sub-sovereign entities or debt securities or governmental debts from the beginning may be 90% or 80% exempted from the taxation.
Okay.
What we have next, we have mutual fund companies. Mutual fund again, they are sell shares in many different types of fund that may be acquire money market, bond, or stock instruments. They may invest in the money market or bond or in stock instruments. The mutual fund securities do not represent a direct issuance of a stock or a bond owned by the mutual fund sponsor or administrator. Remember, in the mutual fund, you do not own in anywhere except the mutual fund itself. You own in the mutual fund, and you are indirectly owning on the owners of this mutual fund. It is a shares sold by the fund itself. Again, it is a shares sold by the fund itself, which own aggregated securities, allowing a smaller investor to easily diversify their investment portfolio. You remember in chapter 5 we took the benefits of the mutual fund, and we said that the main advantage is this allowing the diversification of your investment even with a very small amount.
Yeah.
Right. Let us see the second part is investors who have the money that they want to invest. They are the demand side of the capital markets. They represent the money pushing power in the market. They are the money injected in the markets who is running the market. They may be a retail or an institutional investor. And if I want by my own money, I am a retail investor, or my company is investing, it is institutional investors. Retail investors are individual buying a small amount of stocks or a bond for their investment portfolio. Institutional investors, on the other side, they are large-scale investors, like mutual fund, insurance companies, money managers, pension fund. We take firm of the banks, refer to chapter 3. They purchase large block of securities. They are not investing $10,000 or even $100,000. They are investing millions of dollars. They are large blocks of securities on behalf of others as well as for their own benefit.
Okay.
Now, what we have here also, intermediates. Intermediates are the people who are the link between the buyer and seller. They are intermediate parties who purchase and sell in the capital market securities. They provide main role. Investment bankers, refer to chapter 3, assist issuer in the design and the placement of securities issue. Originators, they are a trading professional tasked with evaluating, pricing, and managing new securities. Securities trader or brokers keep active secondary market for equity and debt instruments. Plus, individual brokerage firms, they are a brokerage firm syndicate. You remember in chapter 3, we
Yeah,
explained this brokerage. We said that the brokerage may be a single broker or an institutional broker.
yeah.
Also, who also we have a player in the market, regulators, the entity that is watching the market and regulating the market. Their main role is to maintain fair and open market, and they guarantee that all parties are equal and no one is having a privilege or having information that is not available to the others. But this is very theoretical. What happened in the actual life is completely different. Regulator for the money market may be different from a banking market depending on the country. Each country has a different regulation environment and different regulation characters. So it is different from country to country. In USA, key regulator for the capital market is SEC. SEC means stock
Security
exchange.
exchange.
Yes, FINRA and MSRB. Type. We have some other participants who are also in the market, rating agencies. You remember the rating agencies, the agencies that are rating you remember in chapter 5 we said that the rating agencies are rating
Moody's and S&P.
Yes, they are rating the issuer and the issue itself. So if for example if SAB Bank, they are issuing a 10-year bond, the rating agencies will give a rating for both, for the SAB itself, for SAB Bank itself, either it is in a good credit worthiness or not, and the issue itself, if it is a good issue or not. We have also transaction processor. The people are selling or booking the sale and everything. Central securities depositors. You remember we talked it in chapter 3, DTCC and the others.
Yes.
External auditors like KPMG, like Deloitte, like Ernst & Young.
PwC.
Yes. Custodians. Yeah, it referred to chapter 3, the one who is taking care of the custody of the investment itself. And the others, this is a very common Right. The investment banking process, what happened in the investment banking process? When investment bank or syndicate takes the responsibility of securities underwriting issue, the issuing entity receives the funds directly from the bank on the issue date. And if you are making an underwriting, you sell all the securities to the investment bank, and you take all your money from the investment bank, and the investment bank then resells these shares. The investment bank markets the securities to the public through the brokerage firm, either a syndicate brokerage or a selling group. The process of the issuing stock or a bond has 3 components. There is 3 stages of the issue of the stock or bond issue. The first stage is origination. The second is underwriting. The third is distribution. Let us take them one by one. What we mean by origination? Origination means creation from the beginning. The investment bank discusses with the issuer the characteristics of the issue and the related documents. He said with the companies that want to issue its shares, he discuss what they do something like a SWOT analysis. What is their strength point? What is their weakness points? How much they want to collect? Is it a time is suitable for the placement or not? The economic conditions, the company financial statement, the company position, everything. Then the investment bank also monitors the market condition and advise the best timing for issuing the new stock. It is not only about the company strengths; it is also related to the economic atmosphere in the country that you are selling your stocks. If it is a recession time, no one will invest. So the choosing of the timing is a very important factor.
Yes.
After we finish this, we go to the second step for underwriting, which is the issuance of the stock itself. In the act of purchasing all or a part of block of securities issued by the company. He may purchase all of them or a part of them. The investment bank is intermediate between the issuer and the investing public. In many cases, the lead investment bank lead underwriter or lead left bank will seek to reduce its risk by inviting other investment bank to join the underwriting process. He may not take the full risk. He may call other investment bank to share the risk with him. This form of
No.
investment banking syndicate, it is something like a syndicate, like we take in chapter 3 syndication loan. We have also here in the investment banking, it may be a syndicate. He do not take the full risk, because if the underwriting fails, he will take the full risk. So he may distribute the risk to other, and for sure he may he will not take the full benefit. Right. If he took a full underwriting arrangement, if it is a full underwriting arrangement, he is responsible for everything. The investment bank or syndicate owns the entire issue. The issuer receives its fund at the point of the investment bank. Syndicate assumes the price and the marketability risk associated with the issue. If it is a full underwriting agreement, the issuer takes his full money from the investment bank, and the investment bank then he is free to do what he do. He takes the stocks and he sell it in a way that he likes, but he is taking a risk, and this risk should be considered the risk of the price and the marketability. Price risk means that the investment bank may not be possible to sell the entire issue at the anticipated price or the target price. Marketing risk means that he may not be able to sell it from the beginning. Marketing risk refers to the probability that not all the shares will be sold. Both type of risk should be affecting the profitability of him. So if he is taking a full underwriting agreement, he should consider these two risks: marketing risk and the price risk. Marketing risk, that means that he is not able to sell the securities. Price risk means that he is not able to sell at the price he wants.
Please come again. Marketing risk, not able to sell.
Marketing risk means that he is not able to sell it. Price risk, that he can sell, but at a price that is different from the price he wants.
Okay.
Plus, the assuming the price and the marketing risk, the investment bank or syndicate may assist the issuer on a best effort base. On the other side, what we talk is a full underwriting agreement. There is something else that is called a best effort base. I will help you on a best offer base. I do not guarantee anything. I only give you my advice and take the price of my advice. In this case, the issuer pays a fee directly to the investment bank as a compensation for advising. He's taking a commission for his advices, and he is not taking any risk. For advising the firm and the marketing the issue, the investment bank does not underwrite the issue. Rather, he is not responsible for the underwriting. He's just telling you his advices or his effort. It is simply help a place shares through a group of brokerage firms. So we have two types of underwriting. One is called full underwriting agreement, where the investment bank takes the full responsibility. He pays the full amount to the issuer, and then he resell the securities in the market. In this full underwriting agreement, he is taking two risks. One is the marketing risk. Marketing risk means that he is not able to sell the stocks. The other risk is price risk, that he can sell, but at a price that is that he do not want. He wants higher price, but the market risk is the market price is completely different. Right, what is the other methodology? The other methodology is called best offer base. In this methodology, the investment bank only give advices for a fees. He is only advising the firm about what to do, and he is taking the cost or the price of his advices.
Okay.
The third stage is distribution. Let us distribute the issue. Requires the sale of securities by investment bank or syndicate. The lead bank takes the responsibility of the management function and receives the major fees. As long as the syndication owns the new securities, each member in the syndicate will use its distribution network to sell the issue. Yani, the distribution means that you sell you give the issue to the brokerage firm in order to distribute their customers. And as long as you have many brokerage firms, you will reach more target audience or more target customers. So if you are 2 or 3 investment bank in investment syndication, each one of you have your brokerage network. So that means that the possibility of reaching to larger number will be higher. For a full service investment bank that offer both underwriting and distribution function, you remember we take in chapter 3, the full service investment bank provide underwriting and distribution function, referred as a sell side of the house, and the investment advisory management function, referred as the buy side, which may result in a conflict of interest. You remember in chapter 3 we take this and we mentioned that you should something like a wall between the advising and distribution.
Yeah.
Ideally, research or recommendation provided by buy side should be independent from the sell side. Both sides should be separated by internal control and the procedure. The wall that we mentioned in chapter 3. We have something called insider trading. What is insider trading? I am now the finance manager of company XYZ, and this company XYZ, its stock is traded in the stock exchange, and I see the financial statement before it is published to the public, and I see the company is making a huge profit, which will positively affect the price of the stock. So I may sell this information to someone, one of my friends or relatives, who buy a large quantity of stocks in order to make a gains. This is completely unallowed. So insider trading is illegal trading of securities based on material non-public information. You know, you have information that is not available to the public, and you use this information to make some profits, either to yourself or some of your relatives or some of your friends or someone in your network. A lot of regulations are there to regulate this insider trading. Discipline engage in the insider trading and enforces related regulation. For example, in United Kingdom, enforcement is handled by Financial Conduct Authority. There is something called Financial Conduct Authority. Enforcement of insider trading varies from country to country. Each country has its own regulations. However, the highest regulation are in the United States. The SEC or the SEC monitors and implements. It is also important to understand that if you are having material non-public information, it is not a crime. The crime that you use this information. The crime resides in the act of use this information. There is no violation of law unless an analyst or traders act on material non-public information. Having material non-public information, but not not using it sometimes occur when a research analyst is brought over to work on the underwriting department. If you are working for an investment bank and you are working in the side of the research and suddenly you move to another side, which is the trading. You come with the information in your brain, you cannot leave the information. So this conflict may happen here. This is known as bringing someone over the wall. You bring someone over the wall. Since the individual being moved from one side to internal control process, the wall of the other.
This is not clear a little bit. The last
for example, we are underwriting investment bank. We have two sides: the research side and the distribution side. I am working as an analyst on the research side, so I have all the information related to all the companies in my brain. Okay. And suddenly there is a internal decision to move me from the research side to the marketing side or the brokerage side. So when I move, I will leave the information, but I have the information in my brain. So when I go to the trading side, my decisions or my recommendation may be affected by the information that I have.
Yes.
Okay. You remember we put this wall to prevent the conflict of the interest, but now you brought someone over the wall.
Yeah.
Okay. The purpose of such a transfer is to add knowledgeable opinion on the underwriting process, thereby adding a value to the once underwriting process is complete. The research employee who has been brought, the ones that you have transferred from this department to this department, over the war is not allowed to comment or on any information learned on the underwriting process until it has become a public knowledge. But this is very theoretical. He for sure he will talk with someone. He will يعني, there is a lot of يعني, for sure that he may talk even on يعني even on يعني unofficial manner.
So my question is that this is no problem. Is it fine that a person who you move from
For sure, it is a big problem. But you know, in order to have a problem, you should prove. But I'm telling you what happened in the actual life. They are discussion كده on يعني unofficial. يعني if we are smoking 2 cigarettes يعني I may tell you information on non-public, and then you use this information to make some money.
Yeah.
Okay. But I will not write an email. I will not disclose it in an official letter. I may say to you as an يعني general discussion or just يعني just chatting.
Okay.
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 Right. Let us take the major controls of the capital markets. The capital market is characterized by different channels used to facilitate the purchasing and selling of the securities. What is main channels is a primary market. Primary market, you remember we said if a stock is a newly issued, offers newly issued debt and securities to investor when issued by a corporate or a government. May be issued by a single investment bank or syndication of investment bank, depends on the issue itself. New issues increase the number of the outstanding stocks or a debt of the issuers. The new issues increase the number of the outstanding stocks and debt of the issuers. If the new shares issued are related to a company has already shares in the exchange, we call it SEO. This is completely this is very important. If a company like Aramco, for example, Aramco, when it is first listed in the exchange, I think in 2019 or so, 2020, we call it a primary market because the company itself, the share of the company itself, is new. Everything is new to the stock, the company and the shares. But now Aramco is already listed, and the company is issuing extra shares or extra percentage. This extra percentage we call it SEO. SEO means seasonal equity offering. Right now, Aramco has already a stock in the market that is exchanged for example 5 riyals. And there is a new stocks have the same rights and the same obligation. For sure, it's the price of the new stock will be 5 riyal because his brother, the old stock is traded for 5 riyals. But the market price of the old shares guides the market price of the new shares. Okay. Type. If the firm, like the example of Aramco, if Aramco is new to the market, if the shares for the public is the first time, we call it IPO, initial public offer. Here, who sets the price? It is a consulting firm which call it يعني guidance price. يعني when investment bank or syndicate takes the responsibility of the securities issue, the issuing firm receive money directly from the investment bank. We call it a full investment agreement or full underwriting on the issue date. The investment bank markets the securities to the public through a brokerage firm, syndication or selling group. The quota is allocated among the brokers based on initial syndication agreement and then allocated to the public. This is يعني internal issue. They allocate the shares between them. Right. What else we have? The secondary market. The secondary market I'm selling to you. The company, the company cash flow is not affected either by increase or decrease. After being sold in the primary market, securities can be sold in the secondary market. Securities sold in the secondary market, so there is no cash either increase or decrease in the cash flow of the firm. Me selling to you, the company either increase or decrease in cash. This transaction may happen through organized exchange or through OTC market. OTC market means over-the-counter market. Type. Organized stock exchange facilitate selling and buying equity of securities. They facilitate selling and buying Organized exchange function provided four benefits. They are providing four benefits. The first one is competitive marketplace. Everything we see, supply and demand set the prices. Frequent trading minimizes the prices volatility between individual trades. If I am seeing Aramco Aramco stock is trading for 4.95, 5.05, I will not sell it for 10. يعني we have يعني a price range. So the organized exchange reduce the volatility in the price between the individual trades. Also increase the depth of the capital market. A lot of people participate, so a lot of يعني increase the depth or increase the volume or increase the customer for this market. Also fair market for participant, because once you open the screen you see everything. OTC market are securities firm choose to keep inventory of securities, debt or equity. OTC markets we have يعني it is يعني ايه يعني it is not stock to keep inventory of securities, more decentralized than formal exchange. It is decentralized. We can meet somewhere in the cafe, for example, and we do the agreement with each other. Rely on electronic communication to do a trading in auction style market between brokers and dealers. Financial market in developing countries or emerging market are often run on OTC basis. This is done in a very poor countries like Africa, for example. Yani Egypt and Saudi, we have organized stock exchange. What we have else? Private market. Private market, it is a closed market. Me and you and yani some of other friends, and that's all. So that's we call it private market. Securities are not offered to the public, but offered to a limited group of institutional investors. We are a limited group of institutional investors. Regulation for the private market change from country to country. They require securities only to be sold to a limited number of high net worth investor or a qualified institutional investors. In order to join this market, you have to be a qualified institutional investor. And for example, your capital may not be less. For example, $10 million. In USA, we call it a QIBS, qualified institutional buyer. Qualified institutional buyer, and these qualifications, for sure, will depend on the money that you have. Provision for the private issue may be tailored to meet the need of the issuing company. We may tailor the issue to meet your need. The regulation for differ from country to country. Qualified institutional buyers manage at least 100 million of securities. The private placement often requires the investor to prove his status as a QIBS, qualified institutional buyer. Why? Because some private placement do not be marketed to non-qualified institutional buyers. Yani, we have something, a group. We are a group. We have a common communication channel. For example, we have a WhatsApp group between us. If anyone have a placement, he will only advertise on this placement inside this group. So if you are not joining this group, you will not know that there is a placement from the beginning. So you have to prove your status as a qualified institutional buyers in order to join this group.
Okay.
Private placements are prepared more quickly than public offering and may have the following criteria. Let us see the criteria. Lower issuance cost, because there is no a lot of advertisements. There is no lower issuance cost, limited disclosures, less restrictions, and higher interest rate for investor offset by lower liquidity for the issuers. Right. Let us talk about the debt market. Organization and governmental entities raise debt in the capital in both short-term money and long-term capital markets. Yani, you borrow either short-term, we call it money market, or a long-term, we call it capital market. Debt capital impose a fixed payment of interest of the issuers. If you are taking the debt, you have to pay a fixed amount at a specific dates. This imposes a fixed payment of interest on the issuer, and at the maturity date, you should refund the original amount. Interest payment is the interest that you pay. The tax authority in the country will recognize it as a deductible expense. It will be deducted from your tax base, so you pay a lower taxes. So interest payment is always taxable deductible expense. Debt holders at the liquidation, the debt holders have the priority before the owners. Debt holder have a priority if the firm asset in the case of liquidation. طيب, let us focus on the medium and long-term borrowing. Many medium and long-term borrowing tools. There is a lot of tools. Basics are loans, intermediate bonds, and long-term bonds. We have something called senior loans. Senior loans means this loan is guaranteed by specific assets, secured against a certain asset. In case of liquidation, they are paid before a subordinated loan. So if your loan is a senior loans, this means that your loan is guaranteed by specific assets. So in case of the liquidation, you either take your full money before the others who do not have a guarantee, or you take the asset that is a collateral.
The senior loans are guaranteed by the
specific assets. Yes, specific assets. What we have else? We have term loan. Term loan is around 70% of the loans. It has a fixed maturity date, usually more than 1 year, and it can be repaid either on one shot or one payment or on installment. The most common type is on installments. Issued with amortized payment, which means that every payment that you pay, part of it go for the principal amount and part of it for the interest expense. Each payment contains a part for the principal amount and the other part for interest payment. Normally not sold in the secondary market, issued for a specific financing need. You want it for a mortgage loan, car loan, financing building of a factory, secured by asset being financed, and the maturity is related to the asset useful life. The lease financing is a very good alternative for the term loans. What we have else? We have medium or intermediate term notes. Corporate or government issue medium or intermediate term notes with a maturities from 2 years to 10 years. In most cases, interest paid on a frequent basis, usually every 6 months, may be actively traded, so they are deemed marketable or liquid securities. Yani they have an active secondary market. You can sell it anytime, and you will find someone who want to buy it. The long-term bonds, we are talking about maturities from 10 to 30 years. Unlike loans, not negotiated with one or more specific lenders, they are bought and sold in the secondary market. The long-term bonds have a secondary market. The loans do not have a secondary market.
I have one question.
This
we discuss about we were discussing about the market, like we discussed secondary market, private market, debt market. After that, we started this medium and long-term borrowing, term loans, medium and term. These are the tools, or what we can say about them?
No. We are still in the market. We are still in the market section. We having the tool that is traded in this market, and after this, we will go in depth for the tools itself.
So this medium and long-term borrowing, term loans, medium or intermediate term loans, long-term bonds, these are part of what?
These are the tools that you may use in each market.
In capital market, equity and debt market.
Yes, right? all in capital market. As long as our maturity is more than 1 year, automatically we are in the capital market.
Tools in capital market. Okay.
Type. The long-term bonds, they are not secured against a specific assets. Also, most long-term bonds pay a coupon. Coupon is the interest payment. Usually, it is every 6 months, semi-annual interest payment at a fixed interest rate over the life of the bond. The interest may be fixed or a variable, but this is depending on the loan. At the end of the period, the principal is paid in full at the maturity date. The bond is considered like a contract. contract between two parties, the parties who lend the money and the party who borrow the money. This contains this contract contains the timing of the borrowing agreement, how long the money will be kept with you, interest payment, interest rate, and any conditions that we may be set between issuing entity or the borrower and the bondholder, who is the contract bond called indenture. This is very common. This is very important word, indenture. What is indenture? Indenture is يعني ايه? Is a contract. It describes a bond issue. If there is a collateral, it will be listed in the indenture. It lists the collateral and when it will be applicable. Also, it puts the warranties or the representations that you put. Also, it specifies the covenants, what we mean by owner, what we mean by lender, what we mean by interest rate, how the interest rate is set, when the payments are due, in which currency, how it will be paid, either in cash, bank transfer, check, everything we put in the covenants. So the covenant states a term by which the company will provide a fund for redemption, set forth for the schedule of interest payment dates and amount, scheduled maturity date, and an early redemption or a call provision. Also, in the bankruptcy situation, when the firm went bankrupt, bondholders are a creditor, so they have a priority in the company assets before the owners. So they have a seniority before the equity holders. Bondholders have a different seniorities. Even the bondholders between them, they have a different seniorities. If your bond is guaranteed with a fixed assets, you are more senior than the bond that have no guarantee. Different seniorities based on the bond, liens, or a pledge on any assets. Bonds may be issued with a call provision. Here is something very important, which is a call provision or put provision. Call provision is some right that's given to the bondholder the right to call the bond at any time during the bond outstanding period and give you your money and take his bond. Usually, this is done when the interest rate decline. So if I am issuing a bond with a 10% interest, so I am paying 10% annually as an interest to the bondholders. Now the interest applicable in the market is only 5%. So why I should continue to pay you 10%? So if the contract between us is giving me a call provision, I will immediately call the bond and give you your original amount, your money, and I will take my bond and I will reissue the bond with a new low interest, which is 5%. So at the end of the day, the amount of liability that I am owed or appearing in my balance sheet is the same, but I reduce the interest expense from 10% to 5%. But all of this is depending either our contract or the indenture contain a call provision or not. Bonds may be issued with a call provision that allows the issuer to call or retire the bond before maturity date. This may happen if the interest rate decreases. Bond also may be issued for a put provision. The put provision on the contract, this gives the bondholders the right to refund the bond to the issuer and take his money. This happens when the interest rate increase. So if I have a bond that's paying to me 10% every year, and now the interest rate in the market is 20 or 25%. So if my contract or the bond indenture giving me the put right, I will give you the bond and take my money, and then I will invest in a new bond that is paying 20 or 25%. So the put provision allows the buyer to redeem bond before maturity by forcing the issuer to buy the bond back. Okay. Let us go in depth for the bonds types. The first type we have is mortgage bond. From its name, it is something related to the mortgage used to finance a specific asset, usually a real estate. The pledged asset serves as a security against the issue. The second item we have something called debentures. Debenture is unsecured bonds. There is no asset in the collateral, which is unsecured bond, represent a general claim against the issuer asset or cash flow. There is no specific asset. It is a general obligation. As long as it has no guarantee, so the risk is higher, so higher interest rate than the secured bonds. Who is issuing this? Large financially secured organization issue bonds based on their credit worthiness. Their credit worthiness is the only guarantee because there is no specific asset guarantee. Organizations do not have easily securitized asset, must use unsecured borrowing. If you have no assets to offer as a collateral, you are enforced to use this. Secured borrowing through debentures.
What is this? You said must use unsecured borrowing, secured borrowing,
yes.
and I think and is missing.
Must use unsecured borrowing. If you do not have assets that you can provide as a security, what we will do?
Yeah. No, after this second line.
Where?
You just must use unsecured borrowing, secured borrowing through debentures.
No, also unsecured borrowing through debentures. Yes.
Okay, I think okay.
Ignore this.
Unsecured borrowing.
Yes.
Okay. So it means that there is no assets offer as collateral.
If you have something to provide as a guarantee, use it and get a lower interest. But if you do not have, you are forced to use the unsecured borrowing and you pay a higher interest rate. Okay.
Okay.
Right. Convertible bonds or a bond that can be converted from one form to another form. So corporate and debt securities can be converted by the holder or the issuer to a shares, either common or preferred stock at a fixed ratio of shares per bond. There may be a condition in the agreement that is saying that at any time or on agreed upon time, the bonds can be issued to a shares, either common or preferred, based on agreement. This is provide opportunity for the capital growth for the investor. At the end of the day, if you are investing in the bonds, the maximum amount or the maximum amount that you can get is the interest that is in the market. However, if you are one of the owners, the limit is the sky. As long as the company is making a profit, your profit is going higher. So sometimes the investor accept a lower interest rate on these bonds compared to the bonds that are not convertible. Some companies you cannot buy the stock directly. You have to buy the bond first, and then this is converted to a stocks later. And some companies they do not provide a selling of stock if they are a very good companies. So the only way to buy this is through buying the bonds, in this case they will give you a low interest rate because of what? Because you have the opportunity at some point to convert these bonds into a stocks. So some investors accept lower interest rate on these bonds compared to the bonds that are not convertible, because this is giving him the opportunity to convert this bond into a stock. What we have else is sovereign bonds. Sovereign bond is government bonds issued by national governments called sovereign bonds or sovereign debts, and usually issued in a currency of the issuing government. For example, Saudi in Saudi Riyal, Egypt in Egyptian pound, United Kingdom in the Great British pound. Issue include all type of governmental debts from US to a developing countries. All the countries are issuing this. Besides the credit risk, there is a political risk. Political risk means what? Yeah, it means there may be a revolution, there may be a coup, there may be a changing in the government, and the new government may say that we are not responsible for all the government debts, so we will not pay. So this political risk should be considered. Also, the forex risk, because it is if you are investing in another country, another currency, you should take care of the currency movement, either devaluation or something like this. If it is issued in a currency different from the investor currency. We have also another grade of the governmental debts called sub-sovereign bonds, municipal bonds. As we told, USA has a three different level of the government. The first level is federal government, then the state government, then the county government. Issued by a level lower than the national government, like region or states. This is commonly in the USA. In USA, it is called municipal bonds. Historically, the primary market was USA, but international market is rapidly expanding due to local governments need to finance a day-to-day operation for a public service that cannot be financed by normal sovereign bonds due to debt ceiling limits or other restrictions. And for example, in Saudi, for example, there is the government of the kingdom. But for example, Jeddah, Jeddah governorate may have bonds. So the kingdom have a bond, but Jeddah have another bond. Both of them are governmental bonds, but different level of government. Bond issued by government entities takes the form of general obligation to a revenue bond. It is a general obligation to the
This sub-sovereign bonds, as you started that there, for example, US, there is federal, then state,
federal
then
and the state
local.
and the county. Yes. Right. For example, in Saudi, there is Saudi government, there is Riyadh governorate,
Yeah.
and then, for example, there is Al Yasmin county. Okay.
Okay.
General obligation bonds are paid from the proceeds of general tax revenue. They are paid from the taxes that the government collects from the people. We have another type of bond called revenue bond. Revenue bond, it is paid from the revenues of a specific project. So if we are making, for example, if we issued a bond to build a stadium, the interest or the principal amount of this bond will be paid from what? From the proceeds of this stadium, from the revenue generated from a specific public project like toll roads or bridges. If you are making a road between Jeddah and Mecca, for example, you have a toll road station that's collecting money from the people who are passing or using this road. This money are used to pay for the bond that we use to finance this road development.
Okay.
Subversion bond subject to many regulation and many of them have a tax effect. In general, they are tax. In the most cases, they are tax free. What we have else? We have Euro bonds. Euro bonds is a bonds issued in a currency other than the currency of the issuing country. For example, Egypt, the currency is the Egyptian pound. So if Egypt is issued bonds in US dollar, it is called Euro bonds. Euro bonds are sold in many countries outside the country of the borrower. Maybe in Egypt, it's selling in France, in Germany, in Saudi, in Gulf. Effective financing tool for giving the issuer, the country that is issuing, flexibility in choosing the currency of the bond based on the regulatory constraints. For example, Egypt, may have a constraint. The bondholder say to Egypt, you cannot, based on the lending agreement between them, Egypt cannot borrow in US dollars. So Egypt, the contract says that it cannot borrow in the US dollar. So, for example, Egypt may issue a bonds in Saudi Riyal, or in Japanese yen, or Indian rupee, or for example, euro, or Libyan dinar, any currency. All of them are euro bonds, as long as it is not Egyptian pound, so it is euro bonds. What we have else? We have something called
but even if they issue in US dollar, then also it's a euro bond.
Yes.
For example.
Yes. As long as it is different from your original currency, it is euro bonds. Your original currency is Saudi Riyal. So if you are borrowing in Egyptian pound, it is euro bond.
Okay.
Right. What we have else? We have zero coupon bond. Zero coupon bond, the normal bonds pay interest on every 6 months, like we discussed. So the zero coupon bond do not pay interest, and they are issued in a value below the par value. So, for example, if the bond is for $1,000, and when you purchase it, you buy it for 900, and there is no dividends paid to you. But at the maturity date, you will receive the 1,000. Your profit is the difference between what you paid and what you get at the date. The par value is refunded by the issuer at the maturity date. Advantage for the issuer: he took money and he do not pay any amount till the maturity date. No outflow of cash till maturity date. Issuing company receive annual tax deduction until maturity because in your financial statement you make something like an accrual for the interest, even you not paid, and this interest is deducted from your tax base. But disadvantage, you don't have the option to call or refund. This is not applicable here. Investors are required to pay a tax in imputed interest earning yearly, even no actual cash received till maturity. You, as an investor, you do not receive any money, but you will pay taxes for the money that you do not get.
So, for example, $1,000 is a par value, and I
Okay.
purchase in $950.
900, yes.
So 50. So there is no maturity date, and after that, I will receive
The
for example
1,000.
1,000. So it's a
Yes.
50 is the profit basically, interest.
Yes.
Okay. Okay.
Right. What we have else? We have a floating rate or adjustable rate that some here it is a debt that do not have a fixed income. It is a floating, going up and down. Floating rate securities carry interest payments that change periodically based on the change in interest rate index. It is a link to a specific interest rate, and this is going up and down. The most common used interest rate index is LIBOR. This was previously it was LIBOR. Now a lot of new exchange rates. For example, SOFR or SOFR, or usually a treasury bills, US treasury bills. Interest rate may be changed daily, weekly, monthly, quarterly, semi-annually, or based on the agreement. Whatever we agree on the duration, it will be applicable. It's very attractive for investors during a period of raising interest rates because if now you have to borrow and the interest rates are very high. So the advice do not borrow at a fixed interest rate. You borrow at a lower a variable interest rate in order to get the benefit when this interest rate go down. Attractive for a borrower if they believe the interest rate is going to decrease. And if it is a higher interest rate now, and you believe that it's going to decrease, you may borrow at the floating interest rate. But there is a risk that the interest rate may go higher. So is a risk, and this risk should be considered. High yield bonds. From its name, there is a high yield, so there is something wrong. So this high interest rate is giving you to compensate you for a higher risk, which is the credit worthiness. So referred as adjunct bonds or low grade bonds. The highly yield bonds usually issued by a less credit worthy entities. There is the risk in the credit worthiness, so we give you this high yield to compensate you for this risk. They offer a high yield to compensate for increased risk. Other bonds, we have something like something called income bonds. They pay interest only if the company has a profit. If the company is not having a profit, nothing will be paid, and this is also included in the bond agreement. Collateral trust bond, supported by securities of the other companies that are owned by the firm issued bond. Equipment trust certificate, you use it to finance the purchase of movable equipment or by the guarantee of movable equipment, usually machinery or a truck or forklift. This is very common in the construction industry. Index bond, the bond is linked to a specific index, and there is the bond rate or the bond interest rate is tied to this index. The interest rate are tied to economic index, often used to when a high level or price inflation. Economic development bond. These bonds are issued by developing countries or sponsoring organizations like International Monetary Fund or World Bank to support the development of infrastructure. For example, in Africa, if you are making infrastructure project, this is through the economic development bond. Tax increment financing, used for local financing, in which we use a portion of new property taxes or a sales tax within a project in a project financing. For example, a company like XYZ government impose a new property taxes for the development of a new area. This is called tax increment financing. We have a tender option bond. The put bonds allows the investor to redeem bonds either once during its life or at specific dates, usually redeemed at a par value.
This what example of tender option bond? An example.
Put bonds allow investor to redeem bonds either once during its life or a specific date. يعني, for example, I may issue you a bond for 10 years and I tell you that you have the opportunity to refund the bond at 1st of February every year. So you have 10 opportunities to refund the bond. You may refund the bond if you need the money now or if you find a better investment. But you cannot, يعني, you have only one day each year to refund the bond. You cannot refund the bond at the 31st of January or 2nd of
Oh,
February. You only have one day.
okay. Okay.
Foreign bonds sold in a particular country by a foreign borrower but kept in the domestic country of the country where issued. Here we have a German company that is selling bonds that is selling in Egypt. So it is foreign borrower. For example, in our example, German company selling in the Egyptian market but kept in the domestic currency of the country where issued. German company selling in the Egyptian market by the Egyptian pound. Multi-currency bond issued as a currency option bond that allow investor to choose among several predetermined currencies or a currency cocktail bonds that are dominated in the standard basket of several currencies. So it is we call it multi-currency bond. It is a cocktail of currencies. For example, it is you may buy it for US dollars, in Saudi riyal, in Japanese yen, in Emirati dirham, in Riyal Oman, in euro. So you يعني whatever the currency you need, you can buy it. What we have also, we have a green bonds. Green bonds is used to finance projects like renewable energy products that is making the planet is a good place to live. Used by federally qualified organizations to raise the funds to promote sustainability by developing underutilized or abundant properties. Corporate bonds designed to proceed for environmental projects, renewable energy, or a project making the building more energy efficient. Okay?
Oh, okay.